Have you ever wondered what capital and share really mean in the world of business and finance? These terms may seem intimidating, but fear not. Today, we'll take you on a journey to explore the fascinating concepts of capital and shares, breaking down their intricacies and revealing how they are crucial to businesses of all sizes. So, get ready for an engaging and informative ride as we delve into the realm of business finance. Did you know that the concept of capital dates back to ancient civilizations like Mesopotamia, where resources were used for trade and production? Similarly, the concept of shares can be traced back to ancient Rome, where they had parties, which were essentially shares in various ventures. Let's dive in and learn more about these essential elements of business finance. What is capital? Capital refers to the financial resources that businesses use to invest in assets, fund operations, and fuel growth. It comes in various forms, including A. Equity capital. This is the money contributed by the owners or investors in exchange for shares in the company. It represents ownership and control over the business. B. Debt capital. This is the money borrowed from banks or other financial institutions, usually in the form of loans, bonds, or lines of credit. Debt capital must be repaid, along with interest, over a specified period of time. C. Working capital. This is the difference between a company's current assets and current liabilities. It represents the funds available for day-to-day operations and short-term needs. What is a share? A share, also known as a stock or equity, is a unit of ownership in a corporation or a financial asset that represents a proportionate claim on the company's assets and earnings. When you buy shares in a company, you essentially become a part owner of the business, with the right to a portion of its profits and a say in its decision-making processes. Types of shares. There are two main types of shares. A. Common shares. These are the most common type of shares issued by companies. Common shareholders have voting rights and are entitled to receive dividends, which are a portion of the company's profits. B. Preferred shares. These shares come with a fixed dividend payment and generally have no voting rights. Preferred shareholders have priority over common shareholders when it comes to dividend payments and the distribution of assets in case of liquidation. How capital and shares work together. Capital and shares are intertwined in the world of business finance. Companies raise capital by issuing shares to investors, who in turn become shareholders. The funds raised through the issuance of shares can be used for various purposes, such as expanding operations, launching new products, or paying off debts. As the company grows and becomes more profitable, the value of its shares typically increases, benefiting the shareholders. Best practices for managing capital and shares. To ensure the financial health and success of a company, it's essential to follow certain best practices for managing capital and shares. A. Maintain a healthy balance between equity and debt capital. Relying too heavily on either form of capital can pose risks. A balanced approach allows companies to access funds without compromising their financial stability. B. Allocate capital efficiently. Companies should carefully assess the potential return on investment (ROI) of various projects and allocate capital to those with the highest potential for growth and profitability. C. Communicate effectively with shareholders. Transparency and open communication with shareholders help build trust and confidence in the company's management and future prospects. D. Monitor share performance. Regularly tracking the performance of shares and the overall market can help companies identify trends and make informed decisions about issuing new shares, repurchasing existing ones, or adjusting dividend policies. A. Consider share buybacks. Share buybacks can be a strategic move for companies with excess cash. By repurchasing their own shares, companies can reduce the number of outstanding shares, potentially increasing the value of the remaining shares. F. Establish a solid dividend policy. Companies should establish a clear and consistent dividend policy that balances the need to reward shareholders with the need to reinvest profits for future growth. The future of capital and shares. As the global economy evolves, the way companies manage capital and shares will continue to adapt. Some of the key trends shaping the future of capital and shares include A. The rise of alternative funding sources. Crowdfunding, peer-to-peer lending, and venture capital are becoming increasingly popular as alternative sources of capital for businesses. B. The growing importance of environmental, social, and governance (ESG) factors. Investors are increasingly considering ESG factors when evaluating companies and making investment decisions, leading to a greater focus on sustainable business practices. C. The impact of technology and digitalization. Advances in technology and digital platforms are making it easier for companies to access capital, issue shares, and engage with shareholders. In conclusion, understanding the concepts of capital and shares is crucial for anyone interested in the world of business and finance. By exploring their origins, types, and best practices, we hope to have shed some light on these essential elements of business finance. As the future unfolds, companies and investors alike must adapt to the changing landscape and continue to innovate in order to thrive. So, whether you are an aspiring entrepreneur, an investor, or simply curious about the world of capital and shares, we hope you enjoyed this journey through the past, present, and future of these crucial aspects of the business world. Like, share, and subscribe our channel for more videos.